In San Francisco, and this is Bloomberg Technology. Coming up in the next hour, Apple's $1 trillion market cap milestone has everyone talking. But with an S&P sector reclassification on the horizon, how big is too big? Plus, the Great Firewall. China wants to be the world's tech leader, but some of the world's leading tech companies still want Beijing to let them in, where Google and Facebook stand in a brewing trade war. And Peloton raises $550 million ahead of a public offering. How does the startup, the home fitness startup, fit into the broader tech IPO market? We will discuss. But first, to our top story, Apple's milestone moment, hitting that $1 trillion market cap, is the talk of the street and beyond. But how big is too big? Keep in mind, there's a dramatic S&P sector reclassification coming in September that will drag big tech names out of funds that have held them for years. This raises the question, does tech have too much pull on U.S. equities? Remember, Amazon, Alphabet, Microsoft, even Facebook aren't far behind Apple. Joining us now to discuss, Bloomberg Television's Romain Bostick and Bloomberg Intelligence senior analyst Jitendra Wawal, who covers internet and consumer electronics. And on the phone, we have Bernstein senior analyst Tony Sacconaghi, who covers Apple and Tesla. And Tony, we're going to get to your exchange with Elon Musk in a moment. But first, Romain, I want to talk to you about this S&P sector reclassification and what it means. Walk us through how the S&P weighting will actually change and how that will impact the big tech names.
Right. So right now, tech is about 26% of the S&P 500 in terms of weighting. At the bottom of that list is telecom. It's about 2%. What S&P wants to do is create a broader communications category. And what that's going to mean is that names like Facebook and Alphabet are essentially going to slide out of the tech sector and into this communications sector. In addition, you're going to have names like Netflix, which is also going to slide out of consumer discretionary and into this tech sector. There's going to be a lot of reshuffling here to the point where that communication sector is going to be about 10% of the weighting in the S&P, and tech as a category name is going to drop to about 20% and maybe less. And this is significant because so much of the trading in the market today isn't really done just in individual stocks. It's done with these sort of basket of stocks, whether you're trading the FANG complex as a whole or whether you're in a broader ETF like the XLK, or you're just trading the QQQ or something. So once these reweightings are done at the end of September, a lot of money is going to have to be reallocated and shifted around, and that really could change the trajectory for some of these stocks.
I do have a chart here in my GTV library showing how Apple does have a bigger market value than 4 of the S&P 500 sectors. Tony, I want to ask you, how big an impact do you think this whole S&P situation will actually have on Apple? And otherwise, how do you expect Apple's business and market value to evolve, given that this is still very much an iPhone company and a rising services company? Tony?
Yes, in terms of the sector reclassification, I do think that there might be some turbulence as those sectors get reallocated. But portfolio managers are really used to focus on individual securities, and many do TMT, telecom, media, and technology together. And so ultimately, I think over time, there shouldn't really be any impact on individual stocks. To your second question about, what does Apple's large size mean going forward, and how do we think about the name? Look, I think trillion is a number, but it does reflect the fact that Apple is a very big company, and it's much more difficult to grow a large company than it is a smaller company. And so clearly, Apple's highest growth days are behind it. And the challenge ultimately is, can it continue to develop products and services that it can push through what is a great brand name and a pretty loyal installed base? I think the key question that I hear and debate with investors is really the health of the iPhone. If you look at most consumer electronic products over time, typically price goes down and typically they mature, and we've seen that across Apple products with the iPod, with the iPad, and with the Mac, all of which are not really growing right now. And so the question longer term is the smartphone category increasingly mature? And if it's a mature category and prices are going down, how much ability does Apple have to really grow that core iPhone franchise?
Jitendra, there are 3 other stocks, Amazon, Alphabet, Microsoft, that are not far behind. Which one of those gets to 1 trillion first? How fast? And really, how fast do they all move? You know, Chamath Palihapitiya, the venture capitalist, suggested that Amazon would get to 3 trillion before anyone else.
Yeah, so the broader question over here is how much the visibility in the future growth is, and that's the difference sort of you're seeing between Google and Amazon and Facebook particularly, where the visibility for Facebook for the near term has gone down. If you look at Google, the catalysts are, your YouTube disclosure. At some point, they're going to disclose how profitable or how the revenue growth in YouTube is doing. You have cloud and some other bets starting to sort of show up. With Amazon profitability growth joining revenue growth is a catalyst, and for Facebook, the catalysts are real with WhatsApp and Messenger monetization, but what's not clear yet is how big can that become, how soon can that happen? And that transition period is what's sort of keeping them on the back foot for now.
Romain, is there a danger for tech to have so much weight in U.S. equities?
Well, I mean, look, anytime you have a stock like Apple that's 8% of the NASDAQ and almost 5% of the S&P, you're going to always have risk associated with the broader market with that particular stock. I think most people will look at the performance over the last few years and say, tech has actually done the market pretty well. When you look at the S&P 500 technology index, it has a total return of about 165% over the past 5 years. That's almost twice what you've gotten out of consumer discretionary. So I think most investors would be happy for that. But again, when you have stocks with this type of weighting, it means that if they were to go down or if there was some huge shift in sentiment, then of course, that would drag the whole market down with it. And then when we talk about, the S&P re-weightings, a big part of the reason why they do that as well is because they're trying to reflect the changes in the economy and make sure that the indexes are weighted in a manner that's probably a little bit more equitable to what the real economy looks like.
Now, Tony, I got to ask you about your exchange with Elon Musk. Of course, you are one of the analysts that he cut off on the last earnings call. He apologized to you on this earnings call. Let's take a listen to what Musk said to you.
Yeah, I'd like to apologize for being impolite on the prior call. Honestly, I think there's really no excuse for bad manners, and I was kind of violating my own rule in that regard. That certainly I have some excuse. There are reasons for it, and that I've gotten no sleep, and I've been working sort of 10-hour or 20-hour weeks. But nonetheless, there's still no excuse. My apologies for not being polite on the prior call.
So, Tony, do you accept his apology, and what is your level of confidence in Musk's leadership and his execution, given the capricious behavior we've seen over the last several months?
So certainly apology accepted. I think you saw in the stock's reaction on the last earnings call that investors were nervous about his dismissiveness of important financial questions. And I think, there has been concern among investors about, does Elon take seriously the investment community? Is he focused enough on financial metrics? Is he statesman-like enough to be running a company? And you saw the negative reaction in the stock following the conference call in early May. I think, an apology and a more straightforward earnings call yesterday was a positive step because, again, investors want CEOs who are focused on financial metrics, who are focused on key investor questions, and who can lead the company, with a level of statesmanship and decorum. And so I think that was a positive step. Now, look, I think most investors who know Tesla well know that Elon is not your typical CEO. He's highly visionary. He tweets a lot. He's very expressive in his views, much less guarded than most CEOs. And so they recognize that that's part and parcel of what you get when you're buying Tesla. Now, I think in recent months, there have been times where that aspect of his personality has been detrimental and distracted to the investment focus. So kind of seeing a step in the positive direction on that front yesterday, I think, generally was reasonably well regarded.
He's setting new targets for himself, 6,000 Model 3s a week by the end of the month, and he says there's no plans to raise capital, that he doesn't need to raise capital. Do you agree?
Well, I think it's possible that they won't need to raise capital this year. They're taking a lot of steps to try and hit that bogey by reducing capital spending by $1 billion versus what they thought they would use at the beginning of the year. They're going to squeeze working capital. They've done a headcount reduction. So they're pushing very hard for that. And so I think it's possible that they will not need to raise capital. Now, on a go-forward basis, I think they will, because this is a company that's going to grow. If you think of all the initiatives that they have planned, whether it be building a factory in China, building one in Europe, launching the Model Y, launching the Semi, rolling out a solar business, this is likely to end. They have $3 billion worth of debt coming due in the next couple of years. That's probably $10+ billion worth of capital that's going to be required to execute those things. And I don't think the company is going to be cash generative enough to fund those. So, yes, maybe they can get by through some austerity measures in the second half of this year. But I do think they're going to need to raise capital. And quite frankly, that's probably the prudent thing to do, because this is a growth company. And you want them to be able to seize market opportunities if they're there.
All right. Bernstein Senior Research Analyst Tony Sacconaghi, thanks so much for joining us on the phone, as well as Romain Bostic in New York for Bloomberg, and our Bloomberg Intelligence Senior Analyst Jitendra Warwal here in San Francisco. Lots to discuss. Coming up, some of the world's largest companies are collaborating and communicating using a Facebook platform called Marketplace. We'll chat with the program lead on expansion and acquisitions next. This is Bloomberg. Back in 2016, Facebook created a collaborative platform called Workplace to be used to communicate via groups, to chat with colleagues, and offer the social network's features in a more corporate environment. Since, Workplace has grown extensively, over 30,000 global organizations using the platform, but there is, of course, competition from the likes of Slack and Microsoft. With more, we're joined by Bloomberg's Caroline Hyde in London. Caroline?
Yes, and we're joined by Julian Cordonio. He is indeed the Vice President of Workplace for Facebook, really running it right here from London. Julian, we were just hearing about so-called competitors, like Microsoft, like Slack. Are they competitors?
I don't think of them as competitors. The mission of Workplace is really to connect everyone in the company, every industry, especially people who've never been connected before, because they never had a desk, never had an email, never had a PC. And I think only Workplace and Facebook in general have that ambition to connect basically 4.5 billion people who are employed with a working mobile device. I don't see anyone else going after that market of connecting absolutely everyone in the company.
And how does that empower the barista at Starbucks, or indeed, the front of sales point in Walmart, for example?
Well, I think it gives them a voice for the first time. They understand who they work for, they understand the values of the company, the culture of the company. They can be identified as talents. They can exchange with their colleagues from other stores, from the HQ. So I think when you give everyone a voice like that, you ultimately change how the company is run, and it gives opportunity to people who did not necessarily have opportunities before.
You've just been on the acquisition trail, a relatively small one, you say, but Redkicks, they're enabling you to have email, to have more the enterprise side of connectivity. How's it going to integrate?
It's a great team, great company, great IP, a team that has been in the SaaS business for a long time. The CEO used to be the VP of product at Jive. So it was a great opportunity for us to accelerate our engineering effort by acquiring that company in Israel.
And what does it say about the purpose of where Workplace wants to go, the ambitions you have, how significant you could be for your parent company?
Well, I think it will help us, thanks to the IP they have developed, to move away from things like mailing lists, newsletters that people don't really like to use, but still have to use sometimes. So I think this acquisition will help us to accelerate that transition and to maybe accelerate the adoption of Workplace when we launch in a new company.
And accelerate the adoption across, you've got 30,000 companies already. Yeah. How global is that spread? How are you making those connections to get inside more businesses?
Well, we are very busy scaling the business. We opened an office in the US, in Australia, in Japan, in Paris, in Brazil. We truly have that ambition to connect everyone, so we have to be present where our customers are, and we can use the Facebook infrastructure to do that. But it's a global business, and we want to make sure that we are the best possible place to serve our customers.
You have subscription model. It's not one that's in the rest of Facebook. How has that worked? And also you're offering it to not-for-profits who aren't going to pay that subscription as well.
No, Workplace for Good, which is Workplace for Non-Profit, is free. But companies who pay for Workplace Premium, we also have a free product called Workplace Standard, but companies who pay for Workplace Premium pay $3 per month, which is, as you said, a new business model for Facebook, but it's the business model of SaaS. And we want people to understand very clearly that Workplace is part of Facebook, but it's a very different product. It's a very different business model. And so we needed to find a way to create like a SaaS brand within Facebook Inc. You have to think of Workplace as a startup, a SaaS startup, the first SaaS startup within Facebook.
You're part of Facebook. The parent company can obviously be a driver of growth, but also in sometimes a hindrance, particularly at the moment when there's concerns about privacy, about data. How are you having those conversations with the businesses that you're talking to and ensuring that they feel completely at ease with the product?
Yeah, we've observed how Google, for example, built a SaaS business with Google Cloud, or how Amazon with AWS did the same thing, how a consumer tech company created a very successful SaaS business. And I think we are going through the same journey. We had to create our own brand. We had to go through all the possible security and privacy certifications you can imagine, the ones you need to be able to serve some of our customers like banks, financial institutions, governments, SOC 2, SOC 3, ISO. So it's a new muscle for us that we are building. But at the end of the day, companies know that Facebook is one of the few companies in the world that is building its own infrastructure. Data centers, the software, the hardware. So we have a lot of credibility as a tech company. We had to build our credibility as a SaaS vendor, being able to serve the most regulated and conservative companies in the world.
Julian Cordonio, I wish I could talk to you for longer. Thank you very much. Come back. He's a big praiser, of course, the ecosystem here in Europe and indeed building Workplace for Facebook and by Facebook right here in London. Emily.
All right, Caroline Hyde for us in London. Thank you so much for that interview. Coming up, the Great Firewall of China. Facebook and Google want in, but at what cost? And how will escalating trade tensions affect the push? That's next. This is Bloomberg. Another salvo has been fired in the trade war between China and the United States. On Friday, Beijing unveiled a list of $60 billion worth of U.S. goods to be hit with tariffs. China says this will happen if Washington follows through on its plan to impose duties on $200 billion worth of Chinese goods as early as next month. President Trump's top economic advisor, Larry Kudlow, said the White House will not back down.
We've said many times, no tariffs, no tariff barriers, no subsidies. We want to see trade reforms. China is not delivering, okay? Their economy is weak. Their currency is weak. People leaving the country.
Joining me now in New York to discuss, senior fellow at the Asia Society, Isaac Stone-Fish. So, Isaac, do you see any end in sight here?
I think this is going to be a story for quite some time. I think both the U.S. side and the Chinese side, at least very publicly, are not showing desire to back down. On Beijing's side, we're gearing up to an important and secret annual meeting among Chinese leaders in a resort town called Beidaihe. That'll happen sometime in August, and after the party leaders meet to discuss some secret agenda that we know very little about, we might see more movement on the Beijing side because there might be a consensus, but it seems potentially unlikely that we'll see anything until perhaps right up to the midterms.
Now, in the meantime, you still have U.S. companies that are dying to get into China. You've got an op-ed out about Facebook, and you recommend that Facebook completely shut down or end its ambitions to enter China. Mark Zuckerberg has said it can't be a company that connects the world if China isn't part of it, but Facebook has been blocked in China for many, many years now. Why are you recommending this?
So in the op-ed that I did in the Washington Post, I recommend that Facebook give up on China because the costs of entering the Chinese market very much outweigh the benefits. The reputational costs, Facebook would almost certainly have to share data with the Chinese government, and also the practicalities of doing so. They'd have to hire an army of censors. They would have to compete in a very, very competitive social media landscape, and it's really hard to see any way that Facebook can enter and succeed in the Chinese market without being a Chinese company, which bad for Facebook, bad for its consumers, and I would argue bad for the world.
Meantime, let's talk about what's bad for the world. Google has been secretly working on an app that could be used in China and would censor results. Many employees aren't happy about this. 8 years ago, Google took a stand and said, we're leaving the country because you are going to make us censor our results. And now this. What do you make of this?
I think it's probably to Google's executive chagrin that this story leaked and The Intercept was able to do such a great story on this. I do think it is quite troubling that the company that has done more in the tech world to stand up for free speech and censorship and anti-censorship values when it comes to China is now bowing to the demands of trying to serve a large, healthy market of 1.4 billion people. And I think it's hard to see this as anything but a capitulation. It's certainly possible that Google will decide not to go forward with this, and it is positive for Chinese consumers who will likely get a better product and a less censored product than the top Chinese search engine right now, Baidu, but it's hard not to see it as anything but sad.
And quickly, in the midst of this trade war, is Beijing likely to make any concessions to Google at all, given the broader atmosphere right now?
I think they certainly might, because it would be a very good PR win for them. It normalizes normalizes China's political system if they have a company like Google, which is seen still as a representative of free speech, if it goes into China and acts like an international company would anywhere else in the world. So I think there could be a lot of good PR upsides for China to do this, and I think they could do it in such a way that they wouldn't fear Google was spreading sensitive information.
Right.
So, yeah.
Isaac Stonefish of the Asia Society, great op-ed in the Washington Post. You should check it out. Thanks so much for joining us.
Thank you.
Coming up, home fitness startup Peloton raised $550 million in its latest round. Could it be the next tech company to hit the public markets? And will it fare better than this week's disappointing debut from Sonos? We'll discuss next. This is Bloomberg. This is Bloomberg Technology. I'm Emily Chang in San Francisco. We are halfway through the year with a number of tech companies having hit the public market. Dropbox, Spotify, and DocuSign all making their debut. This week, we also saw wireless speaker maker Sonos begin trading on the NASDAQ. The company price shares below the marketed range, and now it is trading at about $1.5 billion valuation, half of what it hoped for, though. Fitness startup Peloton, meantime, has also just raised $550 million before a planned IPO. So, how will the rest of the year play out? Here to tell us more, we've got our Bloomberg IPO reporter, Alex Barinka, and Bloomberg Tech's Olivia Zaleski, who had this story out today on Peloton. Alex, I want to start with the broader market. How does this year so far compare to last year?
Folks are super excited about how this year compares. There have been 33 technology and communications listings this year, which includes internet companies. They've raised about $11.5 billion. So that's through July. Last year, in all of 2017, we just had 40 companies raise about $13 billion. So we've almost jumped over 2017 when it comes to new listings in the U.S. And deals, as you said, like Dropbox, like DocuSign, are kind of pushing that number up. Spotify doesn't even count because you'll remember that was a direct listing. So it's been a bigger year. The markets continue to be conducive for initial public offerings, and investors do seem to be paying up for most companies, Sonos maybe the exception.
So, Olivia, Peloton is a profitable company. They are planning to go public. Why do they need all this cash?
Yeah, I mean, the points that Alex brings up may be exactly why Peloton says this will be its last funding round. It just raised $550 million at a $4 billion valuation, which is huge for this company that makes home fitness equipment.
Right.
I think they feel they're profitable. They are going to lose quite a bit of money at the end of this year delivering their new treadmill. But I think they feel like they really need the cash. They need it to grow and to expand internationally. They're opening in England and Canada.
So if they go public, I mean, how many years out is this?
This will be this time next year, I think, is when they're targeting.
So what market are they going to be going into? What does the rest of the year look like and beyond?
So when I talk to the buy side, that is the big question, and there's an increased level of uncertainty kind of being injected into U.S. equity markets around the political space, around what's going on with the discussions with China. So it's prudent for companies, if they're looking to go out about a year from now, to have a bit of a war chest, to have a bit of cash on hand so that they can continue operating. When I do look at Peloton, if I were an investor, I would say, look, I need more proof points with this new product. You have the bike, now you have the treadmill. Is the treadmill going to be as profitable on a gross margin basis as the bike has been? So they will need to kind of be able to sidestep some of those questions and be able to show the proof points 12 months from now.
Meantime, Olivia, you also cover Airbnb, which hasn't really given many signals at all about their IPO.
Yeah, they recently came out, Brian Chesky, the CEO, recently came out and said that they are going to go no later than 2020. He made that very clear to his employees because stock grants will start to expire around then. So he has said we're not going to wait, much longer, and we will be ready to go around this time next year, the back half of 2019.
So
but
what's taking so long?
A lot of work to do. They need to hire a CFO, they need to hire a CMO, they need some independent directors on their board, and there's a ton of regulatory uncertainty for them. New York just came down on them. They're planning to cut their listings in half in New York City, which would cut their New York City revenue in half. So a lot of uncertainty there, and I think they need to deal with that.
And could they face the regulatory crackdown that they're seeing in New York? Could that happen elsewhere?
Yeah, I mean, we're starting to see it in Japan, so a lot of question marks there for them.
So, Alex, when you think about bigger IPOs like Airbnb, like Uber, which, Dara has said, by 2019? Mm-hmm. How do those big ones change the dynamics of the market and the weight?
Exactly. When you look back to, I think Snap is a good example last year, Dropbox is a good example this year. Snap didn't do too great. Snap is a consumer internet company. We didn't see a lot of consumer internet listings because it was unprofitable and it wasn't really able to kind of make investors feel better about those concerns almost a year and a half on for it being public. Dropbox is the other side of the coin. They're an enterprise company. They've done very well, but it was also a much more conservative listing. It doesn't have the same trading premium that some of these consumer internet companies might have and do have in their private rounds if you're an Uber and Airbnb. So those concerns, while private investors might be able to look past them for a chance to get in on these new companies, public investors tend to have a bit higher of a threshold when it comes to how much risk they're willing to accept as these companies go on in their public lives as a publicly traded company.
So where is Uber? Because Dara has been very specific.
So Uber is not saying it's not profitable. It had a profitable quarter earlier in the year, but that's because they sold their Southeast Asia business. But Dara Khosrowshahi, the CEO, says he doesn't really care. He just wants them to have positive cash flow, and it doesn't really matter if they're profitable, that they can still target an IPO by about this time next year.
Which could be quite soon.
That is quite soon. If you were looking at a 2019 IPO, you're probably already thinking about what that means for the process. But we do know in the rigors of reporting, Uber's been a little bit more, they've started basically reporting financials a little bit more like a public company. That came with some of the issues that they dealt with in the past year. Investors want to see more out of them. So if you are looking at a 2019 or a 2020 listing, then you're certainly getting your ducks in a row right now and seeing how you can take that step forward.
The question is, how big is it going to be? I mean, this is a company that raised at a $70 billion valuation, but it hasn't really gone up much from there. given the cultural issues, the upheaval, the selling of the businesses in China and Southeast Asia and beyond.
If you're a public market investor, you're going to be taking that into account, but it's going to come down to financials. We've seen some of these companies like Snap not get the private valuation they wanted. We saw Xiaomi in Asia, same kind of story. They had a big number in mind, and once their financial numbers got out there, they had to rein that in because they realized, look, we're going to have to meet investors at the table, and they're going to have to agree to give us the premium that we want. So if it's 70-80 billion for Uber right now, that could always change. And again, broader market uncertainty is something that plays in the mind of public investors and not necessarily private. So there'll be a lot of factors that go into those valuation conversations, and I'm sure, as we saw with Snap, that number will fluctuate right up until that day when they price their shares.
All right, Bloomberg Tech's Alex Brinka, Olivia Zaleski, thank you both. A massive wrong-way bet on Bitcoin has threatened to dent confidence in one of the world's largest cryptocurrency venues. An unidentified trader made a long position order in Bitcoin futures worth about $416 million on Hong Kong's OK Exchange. However, the exchange couldn't cover the loss when Bitcoin prices slumped last week. So not only did the trader lose money, but all other futures traders who were forced to give up 18% of their profits. Coming up, the game maker behind Kim Kardashian Hollywood has been having a great year, but not necessarily because of its celebrity ties. We'll find out what's up with Glue Mobile next. Plus, a new startup has caught the eyes, or should we say the feet, of Silicon Valley's biggest names. We're going to take a look at how a shoe company is winning over the tech elite by going green. And if you like Bloomberg News, check us out on the radio, listen on the Bloomberg app, Bloomberg.com, and in the U.S. on SiriusXM. This is Bloomberg. Shares of Glue Mobile have almost doubled in the last year as the mobile gaming company announces another successful earnings. But that success in the past has been helped by celebrity status of some of its collaborators. So, whereas Glue Mobile looking for its next big hit? Here to discuss, Nick Earl, CEO of Glue Mobile. So, Kim Kardashian Hollywood was huge for you guys, but some of the other celebrity games apps haven't turned out so well. The Taylor Swift app, Nicki Minaj, you know, why pivot from celebrity games rather than trying to find better celebrity games?
Yeah, so Kim was a huge hit and still is. It's still contributing in a big way.
How big?
It was about almost 10 million this last quarter. It's about 200 million to date, a little over 200 million to date. So it's been a great success. She's great to work with, and we tried to follow on with some other celebrities. It just didn't work. Hard to say why. I think Kim has something special about her, but as a company, we've really pivoted to new types of games. Still games for women, games like Coveted Fashion and Design Home, and that's really been the success of late.
And before we move away from Kim, obviously her participation comes at a cost. So
yes.
How much do you actually make on the game, and how much of a cut does she get?
We do well. She this is I think a big revenue item for her, and she deserves every penny. The incredible brand name and participation and collaboration. So it's a little lower margin for us, but it's been just such a great top line hit. So we're very happy with it.
Still, shares are up 88% over the last year. Yeah. What's driving that if it's not the celebrity games aside from Kim Kardashian?
Well, we were very fortunate to acquire a company about a year and a half ago called CrowdStar, and inside of CrowdStar were a couple games that have been real drivers of growth for us. One is Coveted Fashion, which is where you take models and you dress them up and submit them for voting, and the other is Design Home, which is a similar sort of a construct, but instead of dressing up a model, you dress up a room in a house. And those have really been two of the big engines for us, that along with Tap Sports Baseball.
So then what's in the pipeline? Where is the next big hit going to be?
Well, in our business, it's really hard to know what the next hit is. However, we've got a couple things that we're working on that we're excited about, one of which is a Disney Pixar game. And that's not out till about a year from now, but we're very excited about having the whole cast of characters from the Disney and Pixar universes in this style of game, and we're looking for that to be a big thing.
So what is that game going to be like?
It's a role-playing game or a collectible card game. It's very typical for mobile games, where you go in and you pick a cast of characters and you take them on a journey, and they'll do battle with other groups of characters and such.
Games in Messenger apps. What are the prospects you see there, especially with Facebook Messenger, Apple doing this now in iMessage? How big a growth opportunity could that be?
Yeah, it's hard to say in terms of how it's going to work in the Western markets. It's been doing very well in Asia. We haven't really seen it take off yet from a monetization perspective, but the engagement's been really good. So we're seeing some good indicators. As a company, we're not yet stepping into that, but we'll certainly watch it closely and see how it grows.
Now, it's interesting when you look at the China and the U.S. or Western market. In China, you've got these hardcore games that really dominate, and in the U.S., it's a lot of social games.
Yep.
Do you see that evolving one way or the other?
In terms of the West, I think we'll actually see growth of these social games. I think games that are called casual, that's probably the wrong nomenclature, because a lot of these fans of these more casual-oriented games are big spenders and very, very engaged with these games and spend a lot of time and a lot of money. And I think apps for women, as an example, on the gaming front, is going to see a lot of growth, and that's something that we're really taking to heart.
How much do you think about diversity, and I'm very concerned about diversity in tech in general, but also in gaming? This is an industry that has historically been sort of hostile to women, and social games have helped, but when you have a game where you dress models and vote on them, you wonder about the what good that's actually doing for the world.
Well, it provides a tremendous amount of pleasure for the folks who play it, and 90% are women, so obviously they love doing it. We take the kind of diversity angle very seriously. I have 2 daughters, and I'd love them to be in tech, and so we do our best to hire lots of female creative leaders and help us understand that market, because that's a great opportunity for us.
And do you think about the representation of women in games as well? And how do you think about that?
Yeah, we do, and certainly with Kim Kardashian, obviously it's very female-oriented, and we see that with obviously coveted fashion. So working on and helping us understand the markets as well as being inside the games is a part of the whole.
That, as you said, was a big acquisition for you. As bookings rise, as margins rise, what options are you looking at to return cash to shareholders versus M&A?
Well, we love the notion of M&A, and we think there's a great opportunity over the next 24 months and maybe 36 months to be able to consolidate and buy some studios and bring them in, as long as they're a good structural and financial and cultural fit. So we think we'll be looking very seriously. Really the other option for us, I think, at this point is to invest in development for future games and trying to create more growth games.
What do you think is the biggest competition? Candy Crush?
It's a great question, because there's no one game that we really compete against, or no company that we compete against. I think it's just, as we talk about so much, it's just a share of time, and there's just so much to do on a phone now, whether you're being entertained or you're getting information or some other factor. I think we compete against the minutes in a day and the spare minutes a day, and I think it's our job to really create something that is compelling enough for someone to spend time in it versus somewhere else, whether it's a social network or what have you.
All right, Nick Earl, CEO of Glue Mobile.
All right.
Thanks so much.
Thanks for having me.
Stopping by. We'll be watching for the next hit. Well, Huawei Technology says it wants to become the world's #1 smartphone maker by the end of 2019. The company's consumer division chief, Richard Yu, said on Friday that he wants to surpass current leader Samsung with a market share of more than 20% by the end of next year. Huawei recently grabbed the #2 spot from Apple and has expressed an intention of hitting 200 million smartphone units this year. Still ahead, the shoe startup Allbirds is revolutionizing the industry with its clean technology. Co-CEO Tim Brown will tell us how the company is looking to use its materials to go beyond fashion. And Bloomberg Tech is live streaming on Twitter. Check us out at Technology, and be sure to follow our global breaking news network at TikTok on Twitter. This is Bloomberg. Symantec tumbled Friday after announcing workforce cuts and lowering its yearly revenue forecast. The world's biggest maker of cybersecurity software expects to record $50 million in restructuring costs as it cuts as much as 8% of its workforce this year. Symantec now predicts its yearly revenue to be between $4.67 billion and $4.79 billion as it closed fewer business deals than expected. Alphabet CEO Larry Page, former Twitter CEO Dick Costolo, venture capitalist Ben Horowitz. All of them big names in tech who've been spotted sporting Allbirds, the environmentally friendly footwear sweeping Silicon Valley and beyond. Since launching in 2016, the San Francisco startup has caught the eyes of big name investors from Tiger Global to Leonardo DiCaprio. The company has used wool, castor oil, and even eucalyptus tree fibers to make its shoes and is now adding a new material, Brazilian sugarcane. The sugarcane replaces plastic foam used in soles that use 60% less energy and 95% less water than typical synthetic shoes do. And Allbirds says it is so much more than a shoe company. Joining us now, co-CEO and co-founder Tim Brown. Tim, thank you so much for being here. So you've got these new Sugar Zephyr flip-flops that have this sugarcane as part of the material. How did you come up with sugarcane?
Sure, it's a journey that took about 3 years. My co-founder had a previous relationship with a Brazilian green energy company called Braskem, and we convinced them to reconnect some pipes and effectively replace the petrol with sugar in one of the most commonly used materials in footwear, which is EVA, a foam, which is commonly found in many of the 23 billion pairs of shoes that are made each year.
So what's the technology behind this?
It's effectively something that has been around for decades. We've just convinced this company that this is the right thing to do. Traditionally, the footwear industry and the fashion industry has a sort of a low-cost mentality, going always to the cheapest material, and we think this one is better for the environment, and we've convinced them to change the way they do things, and it's made a big difference.
And you say this is a carbon negative footprint, pun intended.
In its raw form, it is, and that's a big moment for us. I think we came into the fashion industry and into the footwear category that we think has been paying lip service to the idea of sustainability, and this is the biggest moment that we've had in our 3-year history.
So one of the reasons it's a big moment for you is because you're actually open sourcing this technology. Explain how that works.
Sure, we're a small company relatively, and the problem is big. Outside of the fossil fuel industry, the fashion industry is one of the largest contributor to carbon emissions. So we can't do this alone. So we've brought this material to the market, and then we're going to make it widely available to the rest of the footwear industry and other industries to use it.
Is there any difference in the strength of the sole, or how to, aside from the environmental impact, what is the difference?
It's the same thing. And I think that's really the unlock for sustainability, is that we can solve these problems. We can put a man on the moon. We should be able to make a t-shirt and a pair of shoes more sustainably. And the fashion industry has a problem, and there's I think, emerging new family of businesses that are trying to solve this problem.
What about the cost for the consumer?
We have a direct-to-consumer business model that allows us to invest in these types of materials. We're not relying on wholesale. We're not relying on a wholesale calendar. So we release these products when they're ready, and we have the margin room to invest in the materials that are better for the environment.
Nike introduced wool sneakers recently. You have other shoe companies like Tom's with social emissions. What about the competition?
It's fantastic. Look, we believe at Allbirds this is the problem of our generation. We've got to find better ways to make stuff, and this is something that hopefully we're a small part of a larger movement. We're not going to do this by ourselves, but we certainly, it was the biggest day in the history of Allbirds the other day when we released this third big material innovation, and there'll be more to come, and it's really, really important.
Can this be used beyond shoes, this technology?
Look, we think it's got applications in automotive, in solar panels, and other industries, and hopefully we can show that this can be done, and other people will use it. The more the merrier.
So eucalyptus fibers, castor oil, wool, sugarcane. What other materials are you experimenting with?
Lots of them, but it's again, people don't buy sustainability, they buy great products. So we're anchored in the idea of comfortable shoes. The number one reason why people buy shoes is comfort, and so everything starts there. And but we believe if you make it a non-negotiable, sustainable materials can be found, they can be used, and when you do, the cost comes down, and it's a win-win for everyone.
There are other shoes that are comfortable, so I'm curious, what do you think it is that's caught the eye of the tech community in particular? Like, why is Larry Page such a fan?
Look, I think there's a big shift going on in the way that we work and the way that we play. It's sometimes called Athleisure, which is suggestive of this being a trend, and I think it's something far more fundamental. And I think we've seen it come to apparel. I think that the footwear industry didn't quite catch this, and footwear tends to have big logos, be very colourful, and we were able to come in with a design point of view that's very, very simple. We launched with one shoe, which is not how you launch a shoe business, so we've done things a little differently.
Are you making money yet?
We've been profitable from the beginning. We haven't released any numbers on the business, but inside our second birthday, we announced that we'd sold 1 million pairs of shoes. So we've had traction, and I think have a foundation of a big opportunity, but a long, long way to go.
So how big do you think Allbirds can be? I mean, I know you say it's more than a shoe company, or will be more than a shoe company.
Yeah, we're about sustainable material innovation. We're very, very focused on the footwear market. It's an enormous one, both in America and obviously globally. 23 billion pairs of shoes a year made each year, which is some sense of the scale. But beyond that, I think the vision for what we're trying to do is larger, and who knows where we'll take it.
Did you send Larry Page a pair of flip-flops?
The website's live, as far as I know. He can jump online. Hopefully, he'll buy a pair. But we appreciate all the support.
I think he can afford it. So. Allbirds co-CEO and co-founder Tim Brown, thank you so much.
Appreciate it. Thank you for
joining us. And that does it for this edition of Bloomberg Technology. Thank you so much for watching. Happy Friday. We'll see you back here next week.